Are we really living in a bull market? In the current situation, having equity risk managed portfolios makes sense. To be or not to be in a bull market. Following sharp negative performances in 2022, global stock markets are nicely up since the beginning of the year. The only exception is China, where the macroeconomic recovery continues to disappoint investors. But if we consider developed markets, the S&P 500 index is up 9% year to date, the MSCI Europe index 6.6%, and the Topix in Japan 12%. Despite more uncertainties on the macroeconomic front, market volatility has weakened significantly. The VIX index is now lower than 15, and the VStoxx index lower than 20. The situation is not as worse as people thought initially. In particular, if we look at corporate earnings. But this being said, it's still really surprising to see the S&P 500 index completely immune to the bankruptcy of large US banks in March. At the same time, the US 10-year government bond yield went down from 5.2% to 3.9% in only 2 days, an amplitude not seen since October '87. In fact, there is a lot happening behind the scenes, and the overall market has been driven by only a few large US mega-cap AI-related tech stocks. The chart shows the year-to-date return differential between the S&P 500 equal weighted index and the S&P 500 market cap weighted index. The gap has actually never been so large since 1990. And how do active managers perform in this current market environment? Without surprise, we see a very high dispersion between managers, depending on the sectorial positioning, small or large cap bias, growth or value orientation, concentration, and finally stock picking. But what is really reassuring is that our selection of stock pickers are strongly back. BlackRock Global and Constrained is up 21% year to date, Cantillon 11%, AKO 17%. So a significant part of 2022 losses have already been recouped, which is not the case for equity indices. With regards to long-short equity managers, they are back in positive territory in terms of alpha generation. In Asia, and particularly China, most of them have been able to protect efficiently on the downside, and our diversification approach has helped. In developed markets, as central banks' hiking rate cycle seems to be closer to the end, fundamentals make the difference again. Our European long-short mandate is up close to 9% year to date, which is a very good result considering the fact that managers are well diversified in terms of sectoral allocation and rather cautious in terms of market exposure. Having equity risk managed portfolios in this context makes sense.